Thank you for joining us for this episode of our Ultimate Lease Accounting series. In our last video, we went over finance lease accounting and walked through a step-by-step example. During this session, we will cover operating lease accounting and again, go through an example of how to account for an operating lease step by step. Let's get started. We already know that operating lease accounting is where the significant changes for ASC 842 are. Let's talk about the income statement and cash flow treatment of an operating lease first. Under ASC 842, to account for an operating lease, the lessee will recognize a single lease cost over the term of the lease, generally on a straight line basis. And secondly, all cash payments should be presented as operating activities on the statement of cash flow. The straight line lease cost for an operating lease is calculated by dividing all of the required cash payments by the total number of periods in the lease term. This single lease cost equates to the rent expense you recognize for an operating lease under ASC 840, particularly if you had a lease with fluctuating rent payments and you accounted for them on a straight line basis utilizing the deferred rent account. The single lease cost will be called lease cost and not rent under ASC 842. The balance sheet treatment is the same as for a finance lease. Starting at the possession or commencement date, the lease is recorded on the balance sheet as the present value of the required lease payments, with the lease payments being several types of consideration and the discount rate being the rate implicit in the lease, the IBR, or the risk-free rate. Then the right-of-use asset is calculated by adjusting the lease liability by certain specific amounts, such as lease incentives and initial direct costs. The lease liability and right-of-use asset are reduced by the lease cost, which is allocated between the liability and the asset, even though it's still treated as one cost, the straight line lease cost. So let's walk through an example of operating lease accounting to illustrate. The example that follows is example 8 from the Ultimate Lease Accounting Guide, how to account for an operating lease. First, we'll review the set of facts and assumptions. We'll use the lease agreement scenario from examples 4 and 5 in this series, where we walked through how to calculate a lease liability and right-of-use asset. To review the facts, this lease started on October 24th, 2021. The lease term was for 5 years with 2 5-year renewal options. There was a purchase option. There was a rent holiday, base rent of $2,000 monthly and CAM payments, and then rent escalations. So we'll walk through what that means for the lease liability and right-of-use asset. As you may recall in this example earlier, we determined the lease term for this lease to be 180 months and the lessor offered a rent holiday. To calculate the lease liability, first review the payment schedule. For the first month, we had a rent holiday, so there are 0 payments. Then the next group of payments is 179 payments of $2,200. This is the base rent of $2,000 plus the $200 for the minimum sale percentage. And then the 179 total payments comes from 180 for 15 years at 12 months, less the 1 month holiday. Lastly, you have the purchase option of $100,000 that Tenneco said they were reasonably certain to exercise. And then that ends up with total fixed payments of $493,800. The next step in the lease liability calculation is you take the present value of those. We take the present value of the lease payments using the previously established discount rate of 3%. So Excel offers a present value formula, or you can use our present value calculator. Either way, the present value of the payments comes to $380,967. Next, we calculate the right-of-use asset. If you'll recall, also, this example had a couple of additional payments, a tenant improvement allowance, a reimbursement, and initial direct costs. Determine which of these are included as lease components and what their impact is, if any, to the right-of-use asset calculation. For this example, as a refresher, the tenant improvement allowance of $50,000 and the reimbursement of $10,000 paid at commencement are reductions to the lease liability, and the initial direct cost of $5,000 is added back for a net adjustment of $55,000. That results in a right of use asset of $325,967. Now that we know the lease liability is $380 and the right of use asset is $325, we can use those amounts to record the operating lease. You have the right of use asset is a debit for the $325,967 we calculated, and the operating lease liability is $380,967 for that present value of lease payments. Then you record the other payment amounts. The $50,000 of tenant improvement allowances were paid directly to the construction company, which means that they are leasehold improvements, most likely, and that you received $10,000 cash at commencement. Finally, the initial direct costs we're looking at as cash paid out. So this would be the total entry to record the lease. One thing to note here is this is a really simplified example. Depending on real life, timing, etc., instead of a cash payment or leasehold improvements, you may have a payable or an accrual or an expense that's booked and then reclassed when the initial lease entry is made at lease commencement. An example of this would be the initial direct cost. Let's say that those were several separate invoices booked to expense, and then when the lease commenced and you recorded it, you reclassed those out of expense into the lease when it was recorded. So once you know the value of the lease liability and the right of use asset, create an amortization schedule for the lease. You start with the lease liability and the right of use asset and then determine the lease cost. In this case, the lease expense is calculated from the total lease payments of the $393,800 because you want the $100,000 purchase option left at the end of the lease. You take that amount less the net adjustments of $55,000 and divide that by 180, which again is the 15 years with 12 months a year. So you start with $338,800 divided by 180, and you get a total lease expense of $1,882. So now you know the cash payment amounts, you know the total lease expense, you have the total liability, and the net asset balance. From there, the lease liability is reduced like a capital lease or similar to other debt. Interest on the lease liability is calculated using the effective interest rate, and monthly lease payments are allocated between the accrued interest and principal reduction. Then the right of use asset is amortized over the lease term by the difference between the straight line lease expense and the lease liability expense, or the interest on the lease. Since the lease cost is always going to be a constant, and then the interest expense is decreasing as the lease liability amount decreases, the right of use asset expense or amortization will increase over the term of the lease. If you want a look at the full amortization table, that's in the addendum to our ultimate lease guide. This is just to help us illustrate the example. So we have the amortization table created, and now we go into the subsequent journal entries. So we showed you the initial journal entry at commencement, and here is an example of a periodic journal entry. This one we're going to do for the month of February, since that's the first month we make a payment. We have the cash payment of $2,200, that's a credit, and we have the rent expense or lease expense of $1,882. Then we also have the decrease in the operating lease liability and a decrease in the right of use asset. Operating lease liability calculation is the difference between what you paid in the cash and the interest. So that's the liability reduction. And the asset lease expense or asset amortization is the difference between the total lease expense and what you booked for the lease liability or interest. And then that's the total payment. So you use the amortization table to create all the monthly journal entries going forward until the end of the lease, unless there is a modification or termination or some other change in the